Press.
Good afternoon, everyone, and welcome back to the Peterson Institute for International Economics. I'm Adam Posen, the Institute's president, and it's our privilege today to host a speech and discussion with Raphael Bostic, the 15th president and chief executive officer of the Federal Reserve Bank of Atlanta. The elevated inflation dynamics we are experiencing now are obviously unusual. They also are subject to great debate. What are their sources? What are their implications? How seriously should we take them? What's the policy response? And I am delighted that Raphael Bostic has agreed to speak with us today directly on those issues. He and his team at the Federal Reserve Bank of Atlanta have been doing interesting work and important public education on this topic. And as an FOMC member, as well as a distinguished scholar, we're delighted to hear his views. Just for background, Dr. Raphael Bostic took office in June 2017 at the Federal Reserve Bank of Atlanta. Prior to that, he taught at USC starting in 2001, including from 2012 to 2017 as the Judith and John Bedrosian Chair in Governance and Public Enterprise at their school, their Salz Price School of Public Policy. His research has spanned many fields, including homeownership, housing finance, neighborhood change, and the role of institutions in shaping policy effectiveness. I know that I've been influenced by his work on housing issues. From 2009 to 12, and on leave from USC, Bostic was the Assistant Secretary for Policy Development and Research at the U.S. Department of Housing and Urban Development. Prior to joining USC, Bostic worked at the Federal Reserve Board of Governors as an economist and then senior economist in monetary and financial studies, and his work on the Community Reinvestment Act at that time earned him a Special Achievement Award. Dr. Bostic is a graduate of Harvard University in class of 87 with a combined major in economics and psychology. He earned his doctorate in economics from Stanford University in 1995. So we are privileged to have you with us here today, Raphael. Please go ahead.
Well, thank you, Adam, for that warm introduction. It was actually a long introduction. You know, my folks here, they know that I like them short. So next time I'm back, I'll just cut that in half and then we'll be good. But seriously, it's really, really good to be here. Good afternoon, everyone. It's a pleasure and an honor to be with you, as I've long admired the important work that the Peterson Institute does, and it's just a pleasure to be here. Let me open by saying that anyone who doesn't want to live in interesting times showed up in the wrong century. The COVID pandemic is the second tectonic economic shock in these first 20 years of the 21st century. I'm counting the Great Recession as the first, and it may ultimately prove to be the most profound economic shock of our lifetimes. One critical economic element the pandemic has turned on its head is inflation, as Adam noted. The elevated inflation dynamics we are experiencing today are very different from what they were in the months prior to the pandemic. Moreover, the durability of elevated inflation has become something of a contentious subject, and perhaps some of you have participated in some of those debates. Today, I'll spend my time with you discussing this extraordinary inflationary environment of recent months and how I'm thinking about policy in the midst of such an environment. But before I go further, do keep in mind that these thoughts are my own and do not necessarily reflect the views of my colleagues at the Federal Open Market Committee. Now, you'll notice that I brought a prop to the lectern. And in case you can't see it clearly, it's a jar with the word transitory written on it. Over the past few months, this has become something of a swear word to my staff and me. Say the word transitory, and you have to put $1 in the jar. Now, my issue is not with the meaning of the word, but rather with using it to describe current inflation dynamics. Let me explain. The first definition of that word in the online Merriam-Webster dictionary is of brief duration or temporary. Time is explicitly present in this definition, and I suspect that most Americans think of transitory that way. However, the second definition, the one that many economists mean when they say that word, is tending to pass away or not persistent. And this definition is more decoupled from the notion of time. And here is where the use of that word further confuses an already confounding time. The phenomena economists and policymakers are trying to describe are wild price swings among a set of goods and services. These relative price changes resulting mainly from shifts in consumption towards goods and away from services like travel and dining out, and from supply chain disruptions that limited the availability of components such as semiconductors. Instead of that word, I think episodic better describes these pandemic-induced price swings. And by episodic, I mean that these price changes are tied specifically to the presence of the pandemic. And once the pandemic is behind us, will eventually unwind by themselves without necessarily threatening longer-run price stability. In this sense, then, we might anticipate the prices of rental and used cars, lumber, and other demand-specific items to revert toward their pre-pandemic levels. Indeed, we have seen the beginnings of such reversions, which some could take as evidence that the use of that word is correct and fully appropriate. That said, it is becoming increasingly clear that the feature of this episode that has animated price pressures, mainly the intense and widespread supply chain disruptions, will not be brief. Data from multiple sources point to these lasting longer than most initially thought. And by this definition, then, the forces are not transitory. In my view, we are better served by using a word that avoids this inherent conflict, especially when the more colloquial use of the word points to the wrong inference. So my team and I are not going to use that word anymore to describe these issues. Okay, I'm going to put this thing away. The outsized influence of these episodic price swings creates at least two issues relevant to the inflation outlook. First, much like movements in gasoline prices, the dramatic price swings we have seen during the pandemic can cloud our reading of the current inflation trajectory. Take August's Consumer Price Index report, and we may get a similar report tomorrow. Core CPI inflation, which excludes food and energy prices, softened during the month, rising just 1.2% on an annualized basis. That was the smallest increase since February, and it has prompted some to conclude that inflation risks have begun to diminish. Not me. I believe evidence is mounting that price pressures have broadened beyond the handful of items most directly connected to supply chain issues or the reopening of the services sector. If we scrutinize the report, we see that 3/4 of the CPI consumer market basket rose at rates higher than 3% during August. This growing inflationary pressure is echoed by the San Francisco Fed's personal consumption expenditures, or PCE, price dispersion measures. One particularly striking statistic. In July, roughly half of the PCE market basket, weighted by expenditure, posted year-over-year growth rates that outpaced their trailing 5-year averages by at least 2 standard deviations. Now, for those joining us who are not statisticians, when we're in a stable inflation environment, we should see growth rates of these magnitudes quite rarely. So, one important takeaway is that an exclusive focus on aggregate core inflation misses the clear and somewhat troubling evidence of broadening price pressures. Further, this broad-based price pressure is seen in many alternative measures of underlying inflation, a topic I'll revisit in a moment. The second issue, and in my view, the real danger, is that the longer the supply bottlenecks and attendant price pressures last, the more likely they will shape the expectations of consumers and business people, shifting their views on pricing and wages in particular. Inflation expectations among businesses and consumers have, in fact, risen this year. Short-run expectations are sharply higher. Indeed, the Atlanta Fed's 1 year ahead business inflation expectations measure has hit the highest level in the survey's 10-year history. More importantly, longer run inflation expectations measures have climbed as well, with many reaching levels we haven't seen in about a decade. These upside risks to the inflation outlook bear watching closely. Evidence from the Atlanta Fed surveys and regional economic intelligence gathering programs suggests that many businesses anticipate supply chain challenges to linger into the middle of 2022. And the evidence further shows that many firms are already reacting to supply chain challenges in a more structural way. Rather than just waiting out the current supply and production problems, many executives are seeking new or redundant suppliers, changing their inventory systems from just in time to just in case, and taking other steps to insulate themselves from future disruptions of this magnitude. Now, undoubtedly, many of these efforts involve a trade-off between efficient, lean production methods and costlier but less vulnerable configurations. But the key point is that we are seeing that some business leaders' expectations about the resilience of their business models have shifted, which introduces the risk that their expectations for other things could shift as well. Now, we have not seen this sort of broad-based and sudden surge in inflation readings since the great inflation of the 1970s. Now, before I go further, let me make it very clear that I think the conditions and risks today are quite different from that episode. But that era is relevant for today's discussion because monetary policy makers learned a lot from it. And today we have better tools to understand inflation expectations. Economists only began to appreciate the critical role of expectations in the 1960s and early 70s. In those days, the best data came from a twice-a-year survey of economists, not actual price setters. The University of Michigan's survey of consumers' inflation expectations, as we know them today, didn't come along until the late 1970s. On the business side, today we similarly have the Atlanta Fed's Business Inflation Expectations Survey. But even here, let me emphasize that we're still learning. Indeed, our BIE survey is only 10 years old and is just now beginning to yield enough data for us to identify meaningful historical patterns and wrestle with what they tell us. My key takeaway for you here is that we at the Atlanta Fed and in the Federal Reserve System are intently monitoring data and anecdotal evidence to get an early sense of when trends along important dimensions are emerging. At my bank, we have a variety of surveys, metrics, tools, and intelligence gathered from price setters across the Southeast to keep tabs on threats to underlying price stability. Now, one tool I'd like to highlight is our underlying inflation dashboard. It is a collection of 9 alternative price statistics that broaden our view and hopefully the views of others, ensuring that we do not get too wedded to conclusions based on any one inflation metric. I encourage you to check it out on our website if you haven't already done so. Now, I mentioned the dashboard because I'm going to use it here in a discussion of our monetary policy framework. One of the overarching themes in my time on the FOMC has been data dependence. This theme is top of mind, in part because the past decade taught us that preemptive, model-based actions may have prevented many potential workers from participating robustly in the economy. And it is through this lens that I view flexible average inflation targeting, whose acronym is FAIT, and which I pronounce as FATE. You all know the FOMC's statement on longer run goals and monetary policy strategy commits us to achieving, and I quote, inflation that averages 2% over time. The statement continues that following periods when inflation has been running persistently below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. The committee left average and some time loosely defined. In my opinion, it was appropriate to provide a loose definition because it would be unwise to lock the committee into a rigid policy approach, knowing that the economy will likely encounter volatile environments over time, such as the one we're living through. That said, it's obviously important that we think hard and debate precisely how the committee's metrics should be interpreted. And one place to look to inform that debate would be the analytical work that preceded the policy framework discussions, particularly a working paper written by several Fed economists titled Alternative Strategies: How Do They Work? How Might They Help? This working paper explores several possible strategies for implementing a FATE policy. Now, this paper and other work by economists within and outside the Fed indicate that windows ranging from 4 years to 8 years can make sense. And my staff ran the numbers for various scenarios through our underlying inflation dashboard and got interesting results. Now let's start on the long end. So if you can bring up the first slide or the second slide of the packet, what you'll see is a table. And this table, so that we'll go one more. No, that's good. So this table shows the 8-year annualized growth rate for the core PCE and CPI, trimmed mean inflation statistics, the Atlanta Fed sticky price CPI, and other measures tied to the cycle sensitivity of price changes. The two columns display the most recent data, August 2021, and averages calculated as of a year ago, August 2020.
Next slide, please.
No, so you can stay right there. Go back one. Each cell is color-coded to show how close it is to signaling price stability over that horizon. And for each measure, the color green corresponds to being within a 0.25 percentage point of a reading consistent with core PCE inflation of 2%. Blue and yellow are 25 to 50 basis points below and above target, respectively, while red is more than 50 basis points above target and purple is 50 basis points below. As of August 2021, all but one of the measures of underlying inflation we track were green, within 25 basis points of the 2% target over an 8-year average. And core PCE inflation snuggled up to within 10 basis points of 2% over that horizon, up from 1.6% a year prior. So even by the 8-year standard, the longer of the relevant time windows, underlying inflation is close to averaging 2%. Now, at the shorter end of the proposed FATE averaging window, at 4 years, and you can now go to the next slide, we see that indeed we have met or exceeded the FATE standards for this year. Now, if you want to quibble with 4 or 8 year windows, then let's split the difference. And if you go to the next slide, we show you the 6-year window, and we draw the same conclusion whether we look at a 4-year or a 6-year window. Now, closing in on the more recent time periods, 2 years, which is on the next slide, or 1 year, which is in the next slide again, or 6 months, which is on the next slide, what you see here is more red. In essence, all of these underlying inflation measures are pointing to growing, broad-based inflation essentially at or above our target. And that's about all the slides we got. So you can take that down if you want. But what I will say is the upshot for me is pretty obvious. If highly accommodative monetary policy is meant to correct past inflation shortfalls, then we have accomplished that mission. But that conclusion then gives rise to another important question. What constitutes an overshoot of the 2% target? Put another way, what is moderately above 2%? Now, personally, I'm not terribly worried if we are averaging 2.25%, even over a longer period, say a 6-year window. As I've noted before, where I get concerned is if the trajectory of inflation is steep and appears likely to be persistent enough to risk unanchoring long-run inflation expectations. Now, however we choose to analyze the data, I've seen enough to conclude that underlying inflation is indeed above the committee's 2% objective. And upward price pressures are expanding beyond a handful of relative prices elevated by idiosyncratic forces. Now, the food services industry is illustrative of price and wage pressures. Inflation in the food away from home category shows signs of persistence, while employee compensation has climbed sharply as a result as restaurant operators struggle to fill open positions. However, the category is representative of broader measures suggesting wages, while rising more briskly, are lagging prices. Now, certainly, it's too early to proclaim that we are witnessing a wage price spiral like the one that led to the Great Inflation. But conditions do merit watching, and my staff and I are doing just that. So to wrap up, I continue to believe that currently elevated inflation is episodic, driven by pandemic conditions such as disruptions in supply chains and labor markets. A major caveat, though, is that the severe and pervasive supply chain issues will probably last longer than most of us initially expected. Up to now, indicators do not suggest long-run inflation expectations are dangerously untethered. But the episodic pressures could grind on long enough to unanchor expectations. We will be watching carefully. In my view, then, the fate, and this is the real fate, not to be confused with the FAIT fate, the real fate of price stability could be on the line in coming months. I think inflation is likely to remain above 2% going forward, but how far forward, I can't say precisely. But I will say that upside risks are salient. And in terms of policy, I believe the conditions I've described argue for a removal of the committee's emergency monetary policy stance, starting with the reduction of monthly asset purchases, as we discussed in last month's meeting. Now, let me close by noting that this is our first inflationary cycle under the FOMC's new policy framework. So it is clear to me there's value in communicating how we gauge progress toward our inflation goals and what we view as the appropriate inflation signal on which consumers, business people, and markets should focus. I hope I've shed light on my thinking along these dimensions today. So thank you very much. And Adam, let's have a nice conversation.
Thank you very much, Raphael. And sorry for my false trigger. I didn't realize how your chart was going to fill in. Thank you. Thank you as well to your team for putting together such a colorful display to bring home your points. Can I ask you to expand a bit on the FAIT, the flexible average inflation targeting? So there was this discussion going back, say, 2 years ago to the Fed Listens conferences, and then obviously the announcement by the committee, that a certain amount of overshooting to make up for past undershooting was necessary. And as you mentioned, it was justified in part because of potential labor market gains left on the table in the past is one reason. Given that inflation has outpaced wage increases on some measures, and given that the overshoot was arguably due in large part to a supply shock, does this mean that we should be ignoring this year's inflation and looking for more overshoots or pushing further? I mean, you seem to be saying we should not. I guess I'm just asking you to flesh out a bit more what constitutes the right kind of overshoot in flexible average inflation target.
Well, that's a very good question. And, Adam, what I will say is this. What we're trying to do is walk that fine line. We know that inflation is elevated relative to where we had seen it pre-pandemic. And the question really is, how much longer is this elevated inflation going to run? And to what extent is this elevated inflation going to do harm to the economy? Right now, what I would say is I'm not seeing signs that this elevated inflation is doing the kind of harm to the economy which would really call into question our policy stance in terms of interest rates. But I will say, one of the reasons why I'm spending so much time talking to business leaders and following with consumers is that I need to understand to what extent are the current conditions disrupting expectations and leading businesses to start to make decisions and families to make decisions that could undermine the robust growth that we've seen today. So I still have in my head that we're going to take a lower for longer approach, because what we've seen over the last decade is that we can see significant labor market growth and attachment to jobs with inflation not showing high levels of pressure. But we're in a different time now. We're in a very odd time that's unprecedented, with a one-time shock, which is a very big shock, that we really don't have a lot of experience in terms of how people are going to respond to it. So for me, I think we're going to keep the framework. I'm going to stay true to it, but I'm also going to be concerned and nervous as we go through these next several months to make sure that there aren't developments that move in ways that I didn't expect and that could undermine, as I said, our ability to hit our full employment targets.
Thank you. Just continuing along that line, when central bankers like yourself talk a lot about unanchored expectations, there is a school of thought that suggests perhaps inflation expectations in Europe, in the US, and Japan have been too anchored, that they're at a very low level, and even now when we've had very large surges, they don't go up. I mean, is part of the goal of flexible average inflation targeting to make it seem like there's a two-sided risk around the target, or is it just the level to keep things anchored in a literal sense?
So when I think about the average inflation target, I actually think about it in two ways. So one is that I definitely need there to be a belief in the markets and in consumers that risk goes in two ways, because it actually does. And we need to be comfortable with that and not be so tied to a one-sided perspective. And I have a concern that we were in that space pre-pandemic, such that movements to the other side either result in an overreaction or no reaction whatsoever. So I think that two-sided balanced approach to inflation is quite important. But the second thing I do think is that for me, it's really important that we all recognize that monetary policy is not that precise in terms of being able to facilitate and to calibrate to exactly a 2.1 or a 2.255 or whatever it's going to be. And I think that the range for me gives me some comfort in signaling exactly how we think about our policy working, and that we are going to be comfortable with a bit more volatility in terms of what we see in the precise point estimates of inflation, and that range and that variation from the precise 2% level that we have doesn't necessarily mean that the economy is operating inconsistent with our objectives and goals. And I think that's an important thing for folks to keep in mind as well.
Great. Fighting against perceptions of excessive precision is definitely part of your remit as an FOMC member. Pardon me. So just continuing with that, I mean, we have what are now the famous dots or SEP projections from individual members, and what gets focused on is essentially the mean of the means of various forecasts. Do you feel like these dots and these very precise seeming forecasts are a good way to be conveying this information? Should the FOMC be couching things differently? And to be more practical, if your forecast comes true, and I won't use the bad word, the episodic inflation persists for longer than the FOMC members, mean FOMC members seem to be saying, how do you think the Fed should communicate about the fact that the previous forecasts seem to have been overshot?
Well, first of all, if you want to use that word, I'll send the jar to Washington, and you can put some money in there as well. Here's what I think about the dots. So the dots I think are instructive in giving a view to the public of the range of perspectives and views that prevail on the committee. And I think it does send a useful message that there is a diversity of perspectives and a diversity of views, and that we are really debating what's happening in the economy. And that's an important thing for people to understand, that we are not in lockstep. We don't have groupthink. We wrestle with the issues and together come to a consensus view, and that's critical. One thing I also hope that people take into consideration when they see the dot plots is that there's a sequence of them. And over time, as we get more information, their character changes. And so that's one way that we communicate how we're internalizing new pieces of information about how the economy is performing and what we think that information means for how our policies should evolve. What I'll say is, through this pandemic, the economy, from my perspective, has continually surprised to the upside in the United States. My initial forecasts were for unemployment to be high for much longer than it has turned out to be, and that the recovery in jobs was going to be much lower or much slower than it has turned out to be. And both of those have just proven not to be right. So as we've gone through time, I've adjusted my dot plot submissions to reflect much greater growth, much more in terms of jobs, and also higher inflation. And it's also caused me to pull forward some of my thinking about when inflation liftoff will be now, or interest rate liftoff will be. Now, I will say right now, that's still more than a year off in my forecast, and I'm an optimist by nature in this. So there's still a lot to happen, but we do adjust and adapt. And I think that the dot plots are helpful in that, but also things like this are helpful too, because I think there are many, different people process information and hear things at different levels of intensity, depending on the venue. So being out and talking in as many different ways as possible, I think is in our interest. So there's not uncertainty as to how we're approaching our jobs.
I appreciate your including the Peterson Institute audience as part of that engagement. Continuing on this idea of precision in management, you've been very clear about that you think it may well be time to remove the emergency accommodation, but it's a long way off before rate hikes. What do you expect to be the impact of removing the emergency accommodation? Is this like a small rate hike? Is this a signal of future rate hikes? Does it have a direct effect on the economy? How do you think about what a tapering adjustment means for the economy and for inflation?
So I think about the taper really in two ways. The first, when we started with our asset purchases right at the very beginning of the pandemic, a key consideration was to maintain smooth market functioning, to make sure that there was sufficient liquidity in our capital markets so that businesses could do the things that they needed to do, because there was evidence to suggest that that was not happening. The second thing is, and for me was a secondary issue at the time, was around the stimulative effect of the purchases. And so when I think about what the impact is likely to be, I think about it in those two contexts. When we think about market functioning, I think the markets are functioning fine now. There's evidence to suggest there's plenty of liquidity. And so I'm not expecting that there will be a significant adverse impact from our tapering in that regard. And in terms of the economic performance, what we've seen and what I'm seeing is very, very strong, robust demand for product. And the constraints on this economy are mainly on the supply side, as you noted, and as so many have noted. So I'm actually not expecting this taper to do a lot in terms of adversely affecting the speed of the recovery. I actually think the economy has a lot of positive momentum. And the more important factor will be the trajectory of the virus and our pandemic response. Because if you look at what is keeping people on the sidelines, if you look at what is sparking the supply chain disruptions, a lot of it are shutdowns because of the COVID infections or uncertainty and fear about what's going to happen with children. So parents are going to stay home until the school situation is resolved, or childcare, and others who are thinking, I don't want to go to work because I could become exposed to the virus and bring that home to my family. So until those things are resolved, I think that there are going to remain challenges in terms of response, but I don't think the taper is going to really feed into those in a very significant way.
Thank you. You mentioned people, pardon me again. You mentioned people sitting on the sidelines, and there is, of course, a great deal of attention to labor market supply, people's behavior right now, issues of extended unemployment benefits, issues of people's perception of risk, issues, as you mentioned, about child and family care, as well as the stance of monetary policy. Could you say a bit more than you did in your speech about where you see labor force participation ending up and how much you think the FOMC and certainly your own vote should be taking into account labor force participation rather than measures of unemployment when you're deciding have you met the labor goals?
Well, I think labor force participation is a very, very important issue. If you think about today's environment, we have a lot of job vacancies. We have a lot of positions that employers want to have filled, and they're struggling. So it's about individuals and workers getting back into the economy and working to fill these jobs. So the speed of our recovery is very much going to be tied to labor force participation, and it's something I'm going to pay attention to. But I will say this, we are very much, I think, in a transitional period. The pandemic has caused a lot of disruption. It's put stress on families and in businesses in ways that nobody imagined. And it's causing everyone, I think, to take a step back and think about, what their attachment to the labor force is going to look like and whether they should have it at all. So as one example, an employee, one of my research economists, has been doing research to really study, like, who's not coming back. And one group that she's found is that women with young children under age 6, which accounted for a segment which accounted for about 10% of the workforce pre-pandemic, accounts for fully 25% of the unexplained gap in terms of employment. And if you think about that group, young under 6, you have to have childcare. You're not going to go back to work if you don't know where those kids are going to be. You need to know what's going to happen with kindergarten and schools. And what we've seen is very much a lot of uncertainty in that. We know the childcare sector has been hit extremely hard through the pandemic. Many of those providers are small businesses that didn't have a lot of wealth. So there's a lot of unresolved clarity in that space that I think is really an answer for why we're not seeing that participation come back as robustly as possible. My hope, and I'm going to be completely frank on this, my hope was that September was going to be when we had that clarity. Once the schools reopened, everybody had figured out sort of how that new steady state was going to be. I was hoping that people would just know what the rules of the road were going to be and then could make decisions about how much they were going to get back in. But that hasn't happened, as clearly hasn't happened. As has happened so much in this pandemic, the time horizons are just longer than what anybody's initial expectations have been. So I'm hopeful that we get to that place where that clarity happens sooner rather than later, so that we can start to see people come back and really fill those jobs and get our economy humming at the speed that the potential suggests it could be.
This is one of the highest stake calls that you and your colleagues in the FOMC have to make is how much room there is to pull people back into employment. Recently, our common colleague Larry Summers has argued that the U.S. economy is actually below the natural rate of unemployment right now, which presumes we are not going to see much return to labor force participation. Whether or not you want to address that specific characterization, how do you go about thinking about what is the right U-star, or what is the right level of labor force participation, or what warning signs are there for you that you got it wrong if you overshoot or undershoot?
Yeah, so there are a couple of ways that I look at this. The first is to just check with employers and to talk to them and see what their hopes are in terms of filling needs to meet the demand that's in the marketplace. And what every employer I've spoken to has told me is that we still think that there is space for us to hire workers, which to me suggests that we are not beyond full employment, that there's still room to run. Another thing that we know is that many families are wrestling with this. And I have teams out in the field talking to folks and trying to get insights as to sort of how people are thinking. And what is clear is that a lot of folks are still trying to figure this out, and that's important. And one of the things that I think is really a challenge here, and this is one of the reasons why I love our structure in Atlanta, is that most of the aggregate data that you're going to get from the federal government or national governments in general is going to be very backward looking, and it's not going to give us insights as to where people's minds are today. And if we're going to really be on top of this and have a clear sense of what's going on, we're going to need to have that kind of information. So the surveys that we do, the direct outreach to families, to small businesses, and to leaders and communities across my district, that's a way for us to get real-time intelligence so that we will hopefully, and I think we're seeing this now, we'll start to see trends before they emerge and emerge in the aggregate data. And that will allow us to make sure our policy is calibrated appropriately. But we are in a churn period, and I do want to say that I don't know if there's going to be one magic bullet of data that's going to answer this question. We're going to have to look at multiple sources and see sort of how the tide turns for many families and many businesses in, I'd say, the next 6 to 12 months.
Thank you. We're covering a lot of ground, and I appreciate your bearing with us and taking us through your thinking. One of the things you mentioned in your earlier speech was some of the comparisons apt and not apt to the 1970s. Obviously, starting with the difference in inflation expectations anchoring. Could you say a bit more about how we should see or not see parallels? People are starting to use the word, or at least ask the word, in stagflation more recently, and obviously the persistent rise in energy prices is drawing some attention to that. So how do you is that a useful concept for today?
Well, as I said in my remarks, I think the conditions are actually quite different between now and that great inflationary period of the 1970s. If you think about unemployment is much lower than it was in that time. And if you think about the source of weakness, today the weakness in our economy is not for a lack of demand. There's plenty of energy in our economy, and there's evidence that's clear that there's potential for growth in the economy. Our challenge, and employer after employer tells me this, is I wish I could get more inputs so I could meet that demand. So the challenge is really on the supply side, and it's driven, in large extent, to issues around the pandemic. This is where it kind of flows back to that episodic term that I mentioned before. And if we can get past the episode, and we're making strides there, it's going slower than I'd like, frankly, I think that we will see that demand start to be met, and then growth will accelerate. So I actually don't think that the analogy is quite right. And then the other thing I would just say is we have a much better handle on the need to understand inflation expectations and monitor how they are evolving as people are experiencing the world that we have today. And we do that far more regularly, and I think with a bit more accuracy than we have in the past. And that gives me every confidence that when it's time to act as we move forward, we'll have really good information that will allow us to shepherd the economy moving forward in a way that allows for growth.
Thank you. You focus primarily in your remarks and in our discussion so far, we focus primarily on the big picture, real side of the economy, particularly labor markets. Obviously, the Federal Reserve has mandate for financial stability as well. And some members have spoken in the past about the risks of financial instability from overly loose or loose for too long, especially given your distinguished background on real estate and housing. I was wondering how you see risks to the housing market and how that should play into the FOMC's decisions at this point.
Well, as you know, I spent a lot of time dealing with the aftermath of the last housing crisis. And so I have no interest in seeing us repeat that. So as I go around and talk to business leaders and get a sense of the pulse of the economy, I ask a lot about housing. and I ask about sort of the exposure that families might have and whether the bankers and others think that there are challenges that could suggest that we might return to those issues. And I'm not hearing any concerns in that regard. The credit quality of borrowers who are buying homes is higher than it has been before. And there's a lot more equity in the market. And we don't have the same sort of penetration of higher risk loans like subprime lending into the marketplace. The one area.
Sorry, is everything okay?
Can you guys see me?
Yes.
All right, because I can't see you. So I just wanted to make sure. So the one area where I do worry in terms of housing is really around affordability of housing. For those who are trying to get into the first market, the market for the first time, there are real challenges that they're going to face moving forward. So what I'm hopeful for is that much of the dynamics, many of the pandemic dynamics that we've seen will abate. And as the episode sort of falls back, we will see the economy and housing markets return to the dynamics that they had pre-pandemic. What I know is that in my neighborhood, I actually talked to people who wanted to move and said, well, I'm not going to move in the middle of a pandemic or right at the beginning of one. So we do know that in particular markets, and especially hot markets, the supply-demand dynamics kind of got out of kilter. And my hope is that as we get returned to a more normalized economic trajectory, minus the uncertainty associated with pandemic, some of those dynamics will return, and we will start to see prices return to sort of a more normalized trajectory. But to answer your direct question, right now, I'm not getting signals that significant risks are building in housing markets to suggest that we have any financial stability issues on the near-term horizon.
Thank you, President Bostic. We're getting towards the end of our time, but if you're willing, I'd like to just pose a couple more broader questions to you as a longstanding member of the committee. Sure. First, you mentioned some of these equity issues, including just now the idea of first-time borrowers, first-time mortgagers not being able to get into the housing market. There was a great deal of attention focused over the last few years about the Federal Reserve's role in dealing with inequality, whether it was in somehow promoting inequality by its quantitative easing or aggressive policies, promoting inequality by insufficient easing and keeping people out of work. Obviously, there's both serious arguments and plain old conspiracy theories out there. I know you've spoken on this before, but given the febrile nature of our politics right now and the clearly unequal incidence of the pandemic on different groups in society, I'd just like you to say a bit about your current views on how the Fed should be taking inequities in our society into account.
Well, thank you for the question. And I wanted to start where you just ended, which is the pandemic has exacerbated a lot of the stresses and the inequities that we've seen in the economy. This pandemic has found every weak point of our society and pressed through it to make those challenges even more difficult. And in terms of economic access to opportunity, this is certainly true here. When I think about the Federal Reserve policy, I really think about it in two pieces. One is that our mission, our mandate to fulfill maximum employment says that we actually need to see that how employment is evolving in all segments of our society. And to the extent that it's evolving in slower rates in certain parts, that should be a concern, and we should try to understand that and do the things that we can in our policy domain to try to promote that. And I think the long-run framework and its objective of staying lower for longer, letting evidence guide us in terms of when the economy is overheating, holds the promise to get more people who have often not benefited from the fruits of economic growth to be engaged, to get good jobs, and to start to participate more fulsomely with the economy. But the second thing I think that the Fed can do, and the Fed has a long history of this second thing as well, is use its analytical heft to really identify those places where we're seeing constraints in economic performance and calling them out. And to the extent that these constraints fall more heavily on ethnic minorities or on women or on the disabled, those who we know have been less attached to the labor force, then we should do that and encourage policymakers that have the ability to use resources to address them to consider doing so. Because if that happens, we wind up with systems and infrastructure that will really unleash the potential of people who have not really been contributing to our economy nearly as much as they could. And one thing I've learned in my time in this role is that you never know where a good idea is going to come from, and you never know who has talent and who has that insider innovation. And so I want to make sure that in my circles, but also that we collectively give every person an opportunity to be that person, to be the difference maker, and to help us grow to be a more robust and more resilient economy.
Thank you very much for that. Of course, we're all aware of the work of Lisa Cook and her co-authors in showing the foregone opportunities of overlooking potentially innovative people, as well as the injustice of it. And so it's great to hear you putting that into context and practice. Yeah, we agree on that. The final thing I would just say, I would just ask, I apologize, this isn't about me saying, this is about you saying, is on the international side. As usual, I can have a conversation with a distinguished Federal Reserve official, and the international sphere never comes up once. And notwithstanding the fact that we're the Peterson Institute for International Economics, we do think the US does exist in an interconnected world. So how much do you see the inflation developments around the world in the other high income economies in China influencing how you see the inflation effects here and how you understand them? And also just how much do you feel that developments abroad are a potential risk, either upside or downside, for the inflation outlook in the US?
Well, sure. And I would just say for the record, I believe that the US is in a global context as well in its economy. And that's an important thing for all of us to keep in mind. When I look at the inflation dynamics, and let me step back and say, first of all, the pandemic was a global pandemic, and it affected every economy and it has affected every country on the planet. And as a consequence, some of the dynamics that we're going to see are going to be exactly the same or very comparable in the United States relative to other places. So if you look at wholesale prices, or if you look at producer prices, they've basically shot up at comparable levels pretty much across the board. There's some more dispersion when it comes to consumer prices. In part, I think that's really how the economies of very different countries fit together. But even there, among some of the richer countries, we're starting to see them have the same elevated dynamic, which would suggest that this is truly a global issue. I also think about the supply chain disruptions. So you mentioned China and East Asia. Many of the disruptions that are occurring there are because of breakouts of COVID and plants having to shut down, or ports having to shut down. And those realities are also important for understanding the trajectory of the US economy. So we have to understand those things if we're going to figure out what the next stage for America is likely to be. Now, in terms of the risks, I actually think the risks are real. I think this is one reason why it's important that we try to promote vaccine distribution worldwide so that we minimize the disruptions that are happening in terms of our supply chain, and that overseas demand for products remains strong and gets stronger. Because, as I said earlier, the longer that we have these disruptions, the longer that we have these challenges, the greater the risk that expectations shift. And if those expectations shift, they may indeed become unanchored, and then our job becomes a whole lot more difficult. So if we can get the global situation under control collectively, Now, I think that bodes well for the country that I pay most attention to in terms of trying to manage its economic trajectory, but I think will also bode well for the rest of our global economy.
Thank you so much, Raphael. This has been a great tour and a set of insights into how you see inflation and your important views. Please, everyone, join me in at least virtually thanking Raphael Bostic, President and CEO of the Federal Reserve Bank of Atlanta.
Well, thank you very much, Adam. It's good to talk with you.
This meeting is adjourned.